Davos and interest rate decisions in Japan and Europe, the big macroeconomic items of this week will be the monetary policy decisions from the US Federal Reserve on Wednesday the 29th of January, and then the Bank of England on the 30th. With regard to the US Central Bank, the CME FedWatch survey currently puts an 84% chance on no change in policy at this meeting. That would leave the upper band of the target range at 1.75%. However, the same survey puts a 54% chance on at least one cut by year end and just a 6% chance on at least one increase. As such, the outlook statement may be more telling than the decision, especially as the Fed's apparent plan is to leave rates unchanged all year at 1.75%. Also watch for comments on the central bank's intervention in the overnight bank funding or repo market since the autumn. Fed Chair Jay Powell continues to swear blind that this is not QE4. Whether it's QE or not, three things seem pretty clear. 1. The Fed's balance sheet is swelling again. 2. The intervention's been running for longer than expected. And 3. Financial markets seem to be feasting on this cheap cash, as share prices have really motored since the Fed began to pour fresh liquidity into the system from last September, October onwards. All of which begs the question of what may happen as and when the Fed starts to withdraw that support. Now, back here in the UK, the chances of a rate cut seem to be rising after recent weak GDP, purchasing managers' indices and retail sales readings, although you could still argue that all of those were affected by the former Brexit deadline of the 31st of October and the general election of the 12th of December. With the budget due in mid-March, the Bank of England might decide to wait and see if there really is a post-Brexit bounce and how much extra money the government may be going to spend. Then again, it might not. In December, the Monetary Policy Committee voted 7-2 to leave interest rates unchanged at 0.75%, and it voted 9-0 to leave quantitative easing unchanged at £435 billion. But a third member of the MPC, Mr Fleeger, now seems to be leaning towards joining Jonathan Haskell and Michael Saunders in calling for a rate cut. The Bank of England is still running that QE scheme of £435 billion as well. It stopped adding to this, but it's not exactly dashing to withdraw or sterilise it either, and the market doesn't expect any change there at this meeting. On the corporate front, we have a growing number of results releases and trading statements from FTSE 100, FTSE 250 and small caps due in the coming week. Names which may be worthy of further research include Petra Diamonds on Monday the 27th of January, Virgin Money UK, house builder Crest Nicholson and PZ Cussons on the 28th, Wizz Air on the 29th, BT, Evraz, St James's Place, Unilever, TalkTalk and Diageo on a very busy Thursday the 30th, and finally SSE and Shaftesbury on Friday the 31st of January. But for all of those, the name perhaps most capable of causing a fuss in the week ahead is oil major Royal Dutch Shell, and it's due to release its full year results on that very busy Thursday the 30th of January. As we can see here, shares in Shell are down a little bit over the last 12 months, lagging both the FTSE 100 and also the oil price, which is up by around 7% in dollar terms as I sit here. This modest showing comes despite a pledge from Chief Executive Ben van Beurden to return $125 billion of cash to investors via dividends and share buybacks between 2021 and 2025. Now that compares to a current market cap of 177 billion quid or $231 billion, so more than half in dollar terms. However, three issues are hurting Shell shares. First, oil may have rallied in the past year, but only because OPEC oversaw another cut to output in December. Overall, the market feels very well supplied right now. Second, natural gas prices continue to sag thanks to rampant output growth from US shale fields. And third, the pushback against fossil fuels and hydrocarbons seems to be gathering pace. This may mean fund managers and investors who are running ethical, social and governance or ESG screens start to avoid or sell shares in firms such as Shell. Now this combination forced the oil major to cough up a profit warning in late December. The company lowered its oil product sales forecast and also said it would write down the value of certain assets by between $1.7 and $2.3 billion, joining Chevron, BP, Repsol and Equinor in taking similar hits. Now, besides the degree and location of those write-downs, which will hit the stated figures, analysts and investors will dig into three main sets of figures when they look at the full year numbers. The first is the mix and degree of earnings. Gas, upstream, which is oil exploration and production, and downstream, refining and petrol stations, are all expected by analysts to show a drop in profits on a year-on-year basis. That divisional mix means that full-year current cost accounting earnings, which adjust for movements in the value of inventory, are expected to reach $18.1 billion, down from $21.4 billion a year ago. Note that for 2020, the year ahead, analysts are expecting a recovery to $20.5 billion, helped by the assumption of a modest increase in Brent to $71 a barrel and broadly flat gas prices at $2.75 for 1 million British thermal units. Second set of numbers, cash flow. Shell got through the oil price collapse of 2015-16 by cutting investment, selling assets and raising debt. None of those are a sustainable way to pay a dividend, and the good news is that free cash flow more than covered the payout in 2017 and 18. Then cash returns. Shell pays a dividend of 47 cents a quarter, or $1.88 a year. There's no change expected there. The actual cash payout comes to around $15 billion, or £11.5 billion, implying a dividend yield of around 6.5%. Comments on buybacks will also be watched for. They came to $7.3 billion in the first 9 months of 2019. After the hard numbers, analysts will then look to the ESG issue and Shell's strategic progress in the field of renewables. Do note that Shell already owns substantial amounts of solar power capacity, a stake in a solar panel manufacturer. It owns NewMotion, an operator of more than 40,000 home-based charge points for electric vehicles across Europe, and French battery expert Saft. Moreover, Shell has committed 10% of its R&D budget to renewable energy and around a quarter of development spending on low-carbon initiatives. Of course, some of you will counter that means some 90% of R&D or research and development is still focused on non-renewables, and you may therefore feel Shell is not doing enough to meet your own personal ESG criteria. That's a decision that only you can take. Thank you for watching, and I look forward to seeing you next time.